economy crashed. I can't predict that. I can't predict the weather.
I can. I'm a Doppler fucking radar. You took something and you didn't give it back. Then banks screwed you over. Take your pick. Either way, you lost. But I made more money during the crash than before it. You can too. You just gotta stop lying to yourself and ask, what did you do wrong that your family lives in a motel?
Welcome to Market Makers, everybody. Your home for tomorrow's TA today. Often imitated, never replicated. The last two videos, guys, I forewarned you. The two strongest weeks in the stock market, July 1st to July 14th, produced rallies. These are the two strongest weeks going back 100 years. And the key being, we are rallying up to our summer top. Whereas the last 5 years in a row, we've had an average of a 10% drop and we are approaching key resistance. But I wanted to take a moment, and I hope everybody had a fantastic July 4th and July 4th extended weekend there. I wanted to take a moment and talk about market mechanics and manipulation, because on our Discord, a lot of people like to send me clips, get my opinion of what I think about somebody else talking about the market and the behavior. And a common theme I saw last week was market manipulation. They're manipulating the market. That's why it defeated my Elliott wave. That's why it defeated my pattern that I had. Guys, you have to understand what market mechanics are before we talk about market manipulation. The market mechanics of the modern market follow as such. 93% of all money globally is long at all times. Right now, you have historic euphoria in the marketplace with the top 5 stocks accounting for 82% of all the market gains. You have the permabulls stepping out there like Tom Lee, calling for a tripling in the S&P by 2030. So he's looking at what, 17, 18,000 in the S&P in the next 5.5 years. No recession call at all. You have to remember, the Biden administration, his handlers, the puppet masters, they don't have a recession call. The Fed, no recession call. Wall Street, no recession call. So therefore, the market has this bias to push up even in low volume. Now, the other key thing you need to understand is more than 50% of the market, the modern market, is bought and sold by algorithms. These algorithms could use anything from as simple as a moving average, a VWAP, value targets, whatever that is. But they're basically trend following the market. So if you have retail, which historically accounts for less than 20% of the buying in the market, if you have retail floating the market up, you're going to get some algorithmic buying to follow it. The key is, as we narrow out even more, as we approach strong resistance, as we look at the market history for high probability trades, which we are rapidly approaching for this corrective move, the key is to understand the cycles in the market and the mechanics of the market, because when those algorithms hit their value targets, and or one big algo starts selling, triggering other algos to sell. This is why you have that saying in the marketplace, the market goes up in a staircase and down in an escalator, or down in an elevator, whatever you want to use for the nomenclature. But this is what you got to understand. The market falls 3 to 5 times faster than it rises. And when it hits our key targets, you're going to get our 10% drop, our summer drop, where I think you will bottom and then move up for your blow off top, tracking identical to the GFC cycle, to the day that the Fed cuts rates, which I think will be September 18th in the September meeting this year, just like they did in the GFC September 18th for the first rate cut. So understand, when people talk about manipulation, there's certainly manipulation in the marketplace. If you look at JP Morgan and Wells Fargo, they own 80% of the paper trading in metals. We know that they manipulate. Why do we know? Because the federal government fines them. They get fined. They get caught for spoofing and things like that. But when people historically talk about manipulation, they're talking about the 1920s, 1930s, the Charles Dow, W.D. Gann, Richard Wyckoff times. And if any of you ever saw Boardwalk Empire, here's a great clip from Joe Kennedy. Yes, of the Kennedy family. Joe Kennedy, who was a famous market manipulator. Many of the first laws about the stock market and manipulation came from Joe Kennedy's antics. Okay, watch this clip. We'll talk about it on the other side.
You have a gambler's spirit, Joe. Gambling implies risk. I take the risk out of it. How do you manage that? by rigging the game, of course. What else is the stock market good for?
That's Boardwalk Empire, Joe Kennedy talking to the notorious gangster Nucky Thompson. Fantastic series, by the way. But Joe Kennedy would do things like he would call up the New York Times and say, Ford is going to have a strike and they're going to be closing their plants for 2 weeks. He would short the Ford stock. Ford would drop. And then when the New York Times realized, they would call Ford for confirmation or whatever. The New York Times realized there's no strike going on. The stock would rebound. Joe could sell the stock. He did this over and over again, these type of antics in the market. That was classic manipulation. The manipulation we have now, my friends, is from the federal government itself. The big manipulators in the market is the government, which brings me to the unemployment numbers. Unemployment went up once again. It is now at 4.1%. It is up 9 weeks in a row. This is key for a couple of reasons. One reason is the widely tracked and followed Somm rule, right? Claudia Somm, who's running away from her indicator that's been 100% accurate since World War II, which is a 3-month moving average of the unemployment rate going up 50 basis points, has captured every single recession going back to World War II. She's running away from it. I see her on an interview saying, well, no. This time could be different. But remember, everybody, this is an election year. Why would Claudia Somm run away from her indicator with 100% accuracy? Well, I Googled her. Guess what? She was the economic advisor for Barack Obama and Joe Biden. Politics is more important than having your claim to fame be your indicator with 100% accuracy. But there's other ways you look at this as well. Obviously, we are in the deepest, longest, and strongest yield curve inversion in stock market history. And another metric you can track, which even Pocahontas in the Senate is aware of, is this one. Lee, play it.
Since the end of World War II, there have been 12 times in which the unemployment rate has increased by 1 percentage point within 1 year, exactly what you're aiming to do right now. How many of those times did the U.S. economy avoid falling into a recession?
You know, it's not as black and white as very
Just
very
looking
infrequent.
at the numbers, it actually is pretty black
Alan
and white.
Blinder's written a book on this, and
there have been 12 times that we've seen a 1 point increase in the unemployment rate in a year. That's exactly what your Fed report has put out as the projection and the plan based on how you're going to keep raising these interest rates. How many times did the economy fail to fall into a recession after doing that? Out of 12 times.
I think the number is 0.
I think the number is 0. That's exactly right.
If unemployment moves up 1% in a year, up 1% in a year, every single time, all 12 times since World War II, we have had a recession. Okay, so that number is still a couple of bips away. I think we have to get there like 4.4 to hit that number. But the 3-month, 10-year, the 3-month Somm rule, there's a bunch of different rules for unemployment, but the Somm rule is about to trigger. If we go to 4.2 in this next unemployment report, then this Somm rule triggers again. That recession is incoming, okay? And understand, when I talk about the government lying and manipulating the data, in 1994, just like with the CPI, in 1994, we had the unemployment. Unemployment was always, since 1940 to 1994, included the people who were looking for work, the people who took part-time work, and the people who couldn't find work, right? So the people recently laid off. But what they did in 1994 to show lower unemployment numbers, they took the people who took part-time work and the people who could not find work after a certain time period, they took them off the unemployment. That's called U6. U3 is what the media talks about. That's all they talk about. We're at 4.1% on U3. If you actually look at U6, it's at 7.4%. If you actually count all the people that are looking for work that took a shitty job because they couldn't get a full-time job, case in point, you're an engineer, you get laid off, you can't seem to find another job that'll pay you 40 hours a week, so you take a part-time gig. Maybe you know somebody, maybe doing part-time marketing or whatever, but you're still looking for your full-time job. That actual number is 7.4%. Okay. And the reason it's important to track unemployment, Lee, throw up our recession unemployment chart. If you notice in red, the highlights in red, when does unemployment spike every single time? During the recession and post-recession, not prior to the recession. This is why those rules like the SOM rule, the 1% rule with 100% accuracy, the 3-month 10-year yield curve inversion with 100% accuracy are so important. And let me tie this up for you, because why does this matter from a trading perspective? Why would this matter from an investing perspective? This is not an investing show. This is a trading show. But this is why it matters, because through the whole history of the stock market has never once put in its low prior to a recession. What does that mean? That means when the S&P bottomed at 34.89, that's not the low for the cycle. If we get the recession, which is all but guaranteed according to the indicators that track it with 100% accuracy. So could this time be different? Sure, this time could be different. Will this time be different? No, it will not. So what does that mean? That means the S&P will take out its low, historically in 3 sigma bubble standard deviations, guys, going back whether you're looking at the Nifty 50 in the 70s, the 1929market.com, or the GFC, the S&P drops a minimum of 50%. In just a run-of-the-mill recession, a shallow recession, a rolling recession, whatever you want to label that recession, deep recession, depression, doesn't matter. In a normal recession, even if you don't think the market's in a bubble, in a normal recession, the stock market drops 33% historically. So wherever our cycle high is, expect at least a 33% drop when the time comes. Now, remember, they're going to deny this as long as possible. They're going to lie about the data as long as possible. They're going to focus on the parse data like U3 for unemployment versus U6 or CPI, which, as we know, Larry Summers, again, not a partisan, right? Treasury Secretary under Bill Clinton, former president of Harvard. He went back with the CPI the same way that we would have calculated it, the same way we calculated it prior to the Fed changing it. And the CPI high for this cycle would have been 17, 18%. Right now, he has us at 7 or 8% inflation if we use the same CPI from the 1980s. So that's what people are feeling. They never talk about the embedded inflation in the marketplace. They never talk about food costs being up an average of 30% since the pandemic. They only talk about the rate of change. We're up 0.2%. That's great. We're up, annualized, 2.8%, 2.6%. They only focus on that because the real numbers are scary and they don't want to scare the marketplace. They need your money locked up in the market, especially the money managers that are like vampires and leeches that if they don't have clients to give them money, guess what? They don't have a job. And the hilarious point about that is 84%, not my stat, you can Google this, 84% of active money managers cannot beat the S&P over a 10-year period. 93% can't beat the S&P over a 20-year period. That whole business exists as bullshit. They're used car salesmen. Your grandmother, when you hit a market bottom, or just historically, but if you think you're at a market bottom, you can just buy the market and you will outperform 93% of Wall Street over a 20-year period. Think about that. That's a business that should be put out of business, okay? They lie to you on TV in cahoots with the government, and you'll see it, guys. Watch what happens as we make our summer top, get our drop, and then as we rally back up, but the economy, the economic numbers continue to deteriorate. You're going to have one of these moments, just like Ben Bernanke had in the GFC.
We've got many economists, one coming this afternoon from Brookings, who says that there is a recession. Are we in a recession now?
We are in a serious slowdown in the economy, which has very significant consequences for the public, and whether it's called a recession or not is of no consequence.
It doesn't matter if you call it a recession. It's a strong slowdown. Remember, going into the GFC and into summer of 2008, the consensus Wall Street call, the consensus from the Fed was soft landing going into summer of 2008. The market fell 57% by March of 2009. Understand what's up against you guys. You need to remember Remember how the government treats you, how the government focuses and supports Wall Street, because that's what this economy, that's what the hierarchy, the oligarchy structure we have in this country, that's what it's all about, is protecting the top 1% in the country.
America doesn't bail out the losers. America was built by bailing out winners, by rigging a nation of the winners, for the winners, by the winners.
Wow, I went off on a little bit of a rant there, didn't I? That was fun. Guys, if you like my content, please be sure to like and subscribe. Leave me a comment. I reply to them as always. You want to hang out with us on our Discord, you can go to the video description. Great staff, great members. I post additional videos there throughout the week for your enjoyment. We have a good time hanging out there. And if you want to help support the channel, if you plan on trading this market, consider checking out SimpleFX. Fantastic exchange, very simple KYC process. Most people around the globe can use Simple. If you hate MetaTrader, check out SimpleFX because it is an awesome application. Trade all the markets. And Bitunix, if you want to trade all the cryptos without a VPN, without KYC, both those links in the video description. With both links, you get our Market Makers VIP bonus. Let's go ahead and start off on the 10-year, 3-month yield curve inversion. This is the yield curve inversion indicator for recessions, okay? It's not the 2s and 10s. It's not the different ones you hear people talk about. This is what was developed by Cam Harvey, okay? 100% track record. Something I just want to show you guys really quickly. The GFC, from the low of the inversion, the deepest level of the inversion, we hit a 203% lower, stronger inversion, I guess would be the way to say it, in this cycle. So we are twice as inverted on the 3-month 10-year at the deepest point than we were in the GFC. Again, why is this notable? Because the Y2K had a slightly deeper inversion than the GFC. SPX fell 50%, NDX fell over 80%, GFC minus 57% for the S&P, gold fell 34%, silver 61%. And so these are just things you need to understand. We went over this prior video, so I'm not going to go over it now because that was a really long intro, but the yield curve inversion, 100% track record for recession calls, okay? Let's go ahead and look at the US 10 years doing nothing. It's at 4.28. Now, on a basic level, holding this uptrend, but this is a very weak position still in a current downtrend. Will we get another rebound back up? I don't know. Maybe we will. The DXY is a little bit more important to me. DXY broker uptrend line could be another false break. What I think the DXY is going to do, it's at 104.92 right now. I think it's going to complete this W pattern just like this and come right back up into this level. Why is this level important? This is DXY at 107, 106.5. This level is important because this is when you had the S&P trading at 4,200. Okay. So I think that's the level we're going to when we get our summer top and then our subsequent drop. If we look at the DXY here off this recent low up to that current high, you fell right to this 618 at 104.813. So we can get our targets just like I showed you. Go ahead and pull our targets. If this is a low, if this low holds, which we don't know yet, but I'm going to go ahead and get targets anyways, just to get some confluence. 1618 is at 106.951. Again, putting you right back into these highs. And I think that's going to happen with the summer top and then the 10% drop, right? Let's go ahead and move forward. Looking at the Dow had a nice up day and it is now reversed down 30 points. Not down a lot, but it was up several hundred points. You look at the Dow, it's throwing dojis all over the place. It's trying to break out. It's trying to rally. It doesn't have a big enough AI narrative. Remember the stock market rally, top 5 companies, 82% of the gains in the market, the most concentrated rally, depending how you measure it, and stock market history, okay? So this is something you want to watch on the Dow because it is the baby brother to the S&P, 39,666 as I record this. You want to see if you can hold these levels and if you can move up. But really what you need to track is the S&P. You want to trade Bitcoin, track the S&P. You want to trade the Dow, track the S&P because that is the most liquid liquid market in the world. Okay. So the low that you really need to hold is 39,284. You're at 39,668. The high that you want to take out to come up, you need to take out your current high, which is 40,000, which you kissed today, big psychological number, then come up to test 40,213. Then you can get more upside. You're floating sideways here on the daily chart. But again, the Dow's just been stuck. Let's go ahead and look at the ES. Something I want to show you here on the ES from our daily perspective. I just had this chart set up and TradingView's got to do this to me. It's got to make me pull all the way back here. I have it on the daily, guys. I want to show you this on the daily. Where are we now in the cycle? We've been covering it for multiple videos now, but most people won't believe this until it happens, right? Just like my Bitcoin prediction about hitting the higher level target of 52 and change, we fell down to 53K. But this is exactly where I think what I think we are doing right now in this cycle. This is the GFC, guys. We talked about this rally period again, the last two videos now, this July 1st to mid to late July, this rally period, the two strongest weeks in the stock market going back 100 years. 5% rally in the GFC took you all the way to July 16th, and then your summer drop of 12%. The Fed cut rates September 18th. If we do not get a July cut, which the market's not pricing in with a high probability chance, I think we're getting the September cut, which the Fed happens to be meeting on the exact same day this cycle, September 18th. I think you're getting that first rate cut September 18th, and then you're getting your rally back up 7%. You made a new all-time high in the cycle. Market then fell 57%. Getting that rate cut in the GFC and the .com, the market rallied for less than 30 days both times. I think it's going to be the exact same way here, but this is the first trade. Want to get this trade. I want to get this 10% decline. I want to try to get this bottom as best I can and then get this rally back up with the rate cut, with the blow off top, and then flip short again. We're going to be doing that on this channel. It's a shame that the summer doldrums is here and so many people aren't trading because there are some major moves coming up in the marketplace, and these are life-changing moves for some people. This is going to be a lot of fun to trade. Let's look at the S&P. So zoomed out here, guys, on the weekly time frame. This is S&P Futures ES1, okay? Want to look at this. Again, when we look at our broader shapes here, we've talked about the different ways of CWs. This is the weekly chart looking at this from this perspective, okay? So we can pull from our previous January 2022 all-time high, pull it down to your cycle low of 3502 here on S&P Futures, and then look at this. Your 1618. 56.15. You're at 56.21. Harmonic expansion has been achieved. If we start closing below 56.15, looking on a weekly perspective, start banging our head, getting distribution. There'll be patterns, there'll be shapes that are made, such as double tops, 5-wave patterns, such as head and shoulders. These are things we want to look at. Now, the market being that we're only at, what is today? Today's July 8th. We rallied to July 27th last year, right? July 27th, right down here. We rallied to July 27th and then had an 11% correction, okay? So if we continue to rally up, we're going to look at those targets on a smaller time frame on the daily, but understand you're hitting the 1618 at 5615 right now. S&P at 5621. You could get a pull down here and start banging your head and going sideways this week, up and down in this area. And it's going to give us an area to trade because if this was to be the top, I think the S&P is coming down to 5250. If we go up slightly higher, 5250 is a good target. If we start making a top here, 5100, somewhere in that range. I'll show you here on the daily chart. We look at this on the daily. Again, always looking for our W's and M patterns. You can see multiple patterns here, but you can see your W pattern here. We can measure this just like this with our Fibonacci. And we got above the 1618. You can see it held as really clean resistance here, right? Started to make what became accumulation, not distribution. Broke out to the upside. You hit a high today, 56.37. You're at 56.21. My next level target, if we were to pull back and do something like this, right, from a daily perspective, if we pull back and we can hold 55.62, we're at 56.21. If we can pull back, spiral back up, come back up, 57.03 would be my next level target. Or if we just start taking off towards that target. But again, you're at key resistance just above it from a weekly time frame perspective. We covered the 90-week cycle as well in the marketplace in previous videos. We covered the fact that I think you could potentially be rallying out here or going sideways before distribution starts around July 22nd, okay? July 22nd timeframe, that week, same week as last year, could be the week you see this to start to break down as well. Let's go ahead and move forward to the NQ. NQ, we can do the same exact thing. Previous all-time high, November 2021, with Bitcoin and the Russell. Look at your 1618, 20,650. What is the price of the NASDAQ right now? 20,623. You obviously got above it, 20,670 today. So both the S&P, from a huge pattern, weekly pattern standpoint, are either just above the 1618 or struggling at the 1618 right now, okay? This is the time to pay attention to the markets. Something else that's interesting, reciprocal moves in the marketplace. We talk about this all the time. If you look at this, let's go ahead and take a trend-based fib extension. We're going to go to the pandemic low up to the previous all-time high, November 2021, and go down to your cycle low so far. Look at your one fib, 100% move, 1618. It's right on top of it, 20,650. Okay. So when you look at this from this perspective, let me illustrate this for you another way. When you look at this from this perspective of an ABCD, you're looking at a reciprocal move, a reciprocal relationship. A 618 has a reciprocal relationship with what? 1618. And here's your retracement. You see that? Spot 62, 618. Okay. And here's your reciprocal move, 1618. You've made a reciprocal move in the market at key resistance, a 100% expansion as well, following this ABC. Again, key resistance level to track on the NASDAQ. You want to pay attention to this. Let me go ahead and remove some of this and let's zoom in on the daily, see if we can see anything as well. Go ahead and put this thing on the daily. You guys are only going to get this information on this channel. I don't see anybody else talking about this stuff, but here we go. So 1618, 20,650. Again, you had the same exact type of expansion pattern. You had the accumulation, the breakout to the upside, and you're struggling right at key resistance. So what you could see is if the NASDAQ, if we're going to stay bullish, the NASDAQ may pull back a little bit, retest what? Retest these Wyckoff ceiling here that you formed in this little trading range, right? Retest this ceiling, maybe 20,250, 20,300, and then try to do the same move back to the upside, either get a retest or form a W and break out. This week is key if these resistances hold and we start making patterns underneath these peak resistance levels. These could be tradable patterns for the summer top and drop. I don't know how many ways to say it. I anticipate it being a 10% retracement in the S&P. You look at your indicators, nothing really to show in bullish territory, but flat. You have divergences on these rallies, but that's nothing new when you have a narrow breath rally. Let's look at NVDA, struggling to get back up here. We had our cycle peak up here above 140, and now you're at 127.91. Again, just basic TA perspective. If you pull a fib retracement from that high to that low in the sell-off, 618's at 132. Maybe you can struggle back there, 132, 133. And obviously, if you break out more to the upside, 135, 136, then you're looking at the market being carried up. Why? Because NVIDIA has accounted for so much of the gains in the marketplace in 2024. Okay, so you want to watch those levels. The levels you need to hold, 120. You need to hold 120. You get below 120, you can start looking into the teens for further downside. Tesla, we talked about Tesla, had a multi-year contraction here. Strength of the contraction on our market makers Caterpillar and the explosion thereafter. Okay. Didn't know if it was going to break out to the upside or downside, but we knew a big move was coming into the market. We look at Tesla also hitting resistance now. Go to this previous leg, pull this previous leg down. Next level that Tesla needs to defeat is at 253. It needs to take out 265. It opens up these higher levels. If it can get out of 265, then you can look at 299, which is basically 300, which would be a key psychological level, right? So if Tesla was going to continue to rally, do something in this fashion, maybe pull back something, come back up. You want to watch that 300 level as well. But again, we're getting long in the tooth, but we have another week, possibly 2 weeks of the most bullish time period in the year, okay? Going back 100 years. So keep the options open. Right now, I don't have a key resistance level where you're at other than the psychological number of 250. You're just above it. So keep your options open. But overall, you want to see some type of pattern present itself to trade if you are looking to trade. And we're just going to keep an eye on Tesla. Let's go ahead and move forward. Bitcoin, a lot of people want to know about Bitcoin, right? If you go back into some of my videos over the last couple of months, right? This is the thing. Like when you understand how a pattern's building and you understand the cycle that you're in, you can talk about targets that have realistic probabilities of being hit for months, right? And what have I been talking about, guys? Literally for months, anybody that's been watching this channel. 52 and change, right? We highlighted this. So 53K, depending which fractal you choose, 53K and my lower level target of 45, 46. You guys have all heard me say this multiple times now, right? So there's your 46. And then what did we do? If you go back and look at my videos, look at some of the comments with the clown emoji. Back when Bitcoin was up here and I was talking about it, you're a clown. You're never going below 60K. You got down to almost 53K, okay? And you're struggling. But what I want to show you is what I think Bitcoin's doing right now, because we had this sell-off and drop. Did I have a clean chart here for Bitcoin? I do not. Let me get rid of some of these lines so I can show you this, okay? Because this is an important concept to understand. Let me get rid of all my fractal corridors here. And let's go ahead and look at this. So let's look at our symmetrical moves in the market. Geometric trading, the market likes to move in symmetry. So if we look at our date and price range, let's go from the high down to the low, right? First breakdown, 23%, 48 bars. Now, if we go from our low up to the second high here, right? Low to the second high, 27%, within 4% of each other, 20 bars, right? So 48 bars down, 23% down, 27% up. And what's this breakdown? I think this breakdown's about 27.5% here, peak to trough. 26%. It's going to depend on what chart you're looking at, obviously. So look at the symmetry in these moves. You have a 23.5% decline, right? 23.5% decline, 27.5% rally, 26% decline. What do you think a possibility is if the S&P does hold up and continues to push up some? What do you think the possibility is of Bitcoin putting in another 25% move, right? We get a geometric mean of this, but it's probably going to be around 25%. And if we pull this fib down, right? If we pull this fib down from that second peak top to that new low, 618 is right there at 64.9, 65K lined up with the 50-day moving average, right? So we have these consecutive moves of 23%, 27%, down 26%. Let's measure this. What would this be from this low back up to this 618 or the 50? 22, 23% move. So could Bitcoin do this move? It could. Could it also just start breaking down further and not do that rebound? Also a possibility. Just looking at the market symmetry of a decline of 20%, a rally of 27, a decline of 26, we could get a bounce, especially if the S&P does want to come up to like that 5,700 level, that next key level target, if it can stay above that long-term resistance that it's at right now, right? So that's what you want to look at. And if this conversely starts breaking down more, because we've been talking about this pattern, been talking about the fact this is a large three-wave pattern. You have multiple patterns in this, but just from a large three-wave pattern perspective, it was nothing more than a double top, right? You have double tops, which are three-wave patterns within it. You had W patterns within it as well. So you have multiple patterns, but when you zoom out and look at things in a larger time frame, that's all this was. Let's put this on a 3-day. Maybe we can see fewer candles here to illustrate this. So you had the break. You had the break here in the market. And if you look at your targets, if we go to that center point to the second top, where are we coming to? The 1272 is at 52,289 if you continue to break down. And the 1618 is at 46.9, right? Right down here near my fractal that I highlighted. So 46.9, 52, you already came down to just about 53. So you came down to 53. Could you just bounce around here? You could, but that's what I'm saying. Watch for that 20+% move back to the upside, because on a larger pattern perspective, what you could be doing is a simple harmonic pattern of 3 waves to a bottom, okay? I'm going to illustrate this for you here. Take this from the second peak here down, 22%. take this from the second peak where it actually broke down, take this to 26%, and then you get your rebound if it came up to the 618, and you come back down another 23, 24, 25, 26%, takes you right to my 45, 46K target. And that would look something like this, right? So 3 waves to a bottom. Wave 1, rebound, right? Wave 2, rebound, back up to maybe the 618. Wave 3, final wave down to the bottom. And then what happens, guys? With the market bottoming, and then I believe the market will bottom the S&P after its 10% correction, and then you get your blow off top. I think you'll see the same in Bitcoin. My targets have not changed. Even though we hit this higher level target, the S&P hasn't sold off yet. It's still moving up to build its top, which is why I think that mid-40s level is still in play. And that's the pattern I would be watching for. First of all, see if you hold this low, see if you can rebound back up to the low 60s. And then if you do, right at the 50-day on the daily chart, if you do and that holds as resistance, I would expect the next wave back down. Okay, let's go ahead and look at this. Solana fell right to our fractal high. Again, exact same pattern you have on Bitcoin, 3-wave top, right? But this, again, will form like this. Wave 1, wave 2, could get a rebound, some type of rebound here, and get your wave 3. That wave 3, you're going to come down in Solana. If we go ahead and measure this, if you're going to come down in Solana somewhere, this could take you down right into, I think it's going to come down in the middle of this corridor, somewhere in the 90s here. So you could be in the 90s on the higher level, maybe the 112, but I think you're going to come down into the 90s. And if you come down to that base, let me pull that down. If you come down to that base, that would be $80, $78. So somewhere between 80 and 100, I think Solana is going to settle when the markets do roll over. But before that, you could get this rebound back up before that third final push down for a bottom, and then the final rally when all the salesmen come back on TV and tell you to buy, historic buying opportunity as the economy deteriorates. You'll see crypto pop up as well. Right now, you're holding really nicely at 127. You're at 136. See if we get a rebound and then see if you sell back off. That rebound, by the way, if we take it from the second top here, watch the 163, 174, if you can get that much momentum to come back up. Watch those two areas, see if you can get up there and see if it fails and you start to push back down again. If we look at the Euro Stoxx 50, Euro Stoxx 50 had a big rally up today as well, all the way up to 5,067. It's currently at 5,001, 50 biggest companies in Europe, and you're spiraling. You see this? You're spiraling, pulling a fib from your high here, your cycle high to that low. The 786 is 5,048. That's your resistance line right now. We'll see what happens. It's going to track with the U.S. market. So again, if they can push up some more, you'll see the other international markets attempt to push up just like the DAX. Look exactly what the DAX did, pulling the fib from its all-time high down to that corrective low so far. The 786, 18,793 has rejected you twice. You rallied up today. You sold back off. Current price, 18,612. Again, when you look at the DAX from this perspective, I mean, the DAX is basically in a channel, okay? It's basically in a channel here. If you just draw this out, you can use a parallel channel as well. But you can just draw this out and you see the DAX is basically trading like this, right? So again, you could come back down and retest this range, but if the European markets could lead the US markets to the downside, they led them to the upside. So if you start seeing this fail, especially if you break out of the base of this channel, you really want to watch the US markets, because if they push up a little bit more and you get this divergence with the international markets, it's going to be key to track. But watch this, see if we can get back up here for a third retest, 18,793, if you wish to trade the DAX. And it's all going to depend on the US markets holding these key resistances or breaking out. You look at the FTSE. FTSE, basically same thing, guys. It's just spiraling. You can see it spiraling here. So it's going to have a move coming in when it's done spiraling. You're getting up to about the 50% retracement at 8302. You got as high as this 618 at 8350. So again, if you lose your lows here, if you lose the 8115s, you're coming back down to the 8,000 level in this cluster of candles. You need to break out, get above 8350, get above 8409 to really have a lot of upside. But these, to me, guys, are all going to be topping patterns in confluence with the U.S. markets. Go back and look at all the retracements, the key retracements. Go back and look at the July 27, 2023 top, and then the bottom in October of 23, and look at how the foreign markets followed the U.S. markets. So keep that in mind when you're trading these assets. Gold, very tight trading range, 24.31. 22.77 is your base. Current price, 23.58. What will gold do? It'll be interesting. If the markets do sell off 10%, will gold pull back to its long-term multi-year ceiling of 2069, or will it be able to hold up here in the 2100, 2200 level, just give you a softer pullback? We'll see. But I think ultimately it will pull back some with the markets, but maybe it won't, right? Maybe it won't, but I don't have a bias here. You're just going sideways. You got to get above 2431 or below 2277. I don't have any type of discernible pattern. I have a high and I have a low. Then I have a higher high and a higher low, but you're coiling sideways, right? So you got to break out one way or the other. One of these will break out in one direction. All right, guys, hope you enjoyed the video, and I will see you guys on the next episode. Take care, everybody.